Greetings guys, Joseph James here once again from the schooloftrade.com, and tonight's trader tip. Now, one of the most popular questions we get from our members continues to be, how do we read the tape? In other words, using the ticker tape, the time and sales, your trading dome, how do we use what we consider to be the purest form of the market, that is the price action, or as the trades are placed in real time, how do we use that to place our trades? In other words, how can we use that to become better traders? Before we get started, I want to remind you guys about our free 30-day trial. Send us an email, sales@schooloftrade.com. Ask us about how to get signed up for your free 30-day trial. Now, involved in that trial, come join us for 30 days in our live trade room, where you'll see us calling rules live in real time according to the James Wave method of trading itself. You'll also be exposed to our intense training sessions, our closing bell review. Send us an email, sales@schooloftrade.com, for more information on how you can get signed up for that free 30-day trial to come out and let us show you just how good we really are. Now back to reading the tape. What's the definition? Well, the definition of reading the tape is attempting to predict short-term price changes by examining price action and volume information as it comes across the time and sales window, or the ticker tape. Now, like we said before, the ticker tape is considered to be the purest form of the market. In other words, there's no technical indicators being used to interpret this as it comes across the tape. This is every trade that's executed. So it's going to start on your trading dome as waiting in line to be executed. And then, of course, it comes across your time and sales window, or your ticker tape, once it's executed in the market. So it's the purest form of the market, and it can be considered to be the pulse of everything going on, all of the opinions, all the fear, all the greed, everything summed up in the form of price action. Now, how do we use it? Well, tape reading, or reading the tape, it's used most commonly at price points in the market where we expect traders to react. So we're not normally going to be paying attention to this stuff in the middle of open free trading, okay, where there's no support and resistance levels. Typically, we're going to look at these at high of day, low of day, in other words, the extremes of the market. How are the market participants reacting around these levels? As well as that, you've got different pivot points, such as the value area high and low, your point of control, moving averages, anything that we expect to be a reaction point in the market for traders. This is where we take the pulse of that market, looking to see what the purest form of price action looks like. Now, specifically, we're looking for the speed of the orders, or the speed of the tape. One technique that we'll tell new members is to kind of blur their eyes and not pay attention to the exact price information, but more importantly, just the speed of the ticker tape itself. If it's moving very rapidly, then you know there's a lot of activity in the market, okay, a lot of volume in the market. If it's moving slowly, for example, look at 9:30 a.m. on the S&P E-mini, and then look at, say, 11:45 or 12 over the lunchtime session. You should see a pretty steep difference between the speed of the tape at 9:30, when there's a lot of volume, a lot of activity going on. There are trades being taken, and of course that shows in the time and sales window. Fast forward a couple hours later, when most traders are taking their lunch break, you'll then see that speed of the tape slow down. In other words, there is less activity on that time and sales window. In addition to the speed, we also look at the size of the orders. Now, of course, the size of the orders will give us a heads up as far as what type of participants are in the market. Are they small retail traders like you and I, trading our 3 lots or our 10 lots or even our 30 lots on the S&P? Or are they large institutional or paper traders? Are they managing a hedge fund, or are they a pension fund manager? Okay, in other words, are the size of their orders, right, 5,000, 10,000, large orders? Okay, this is the difference between a 500-pound linebacker, right, and a 150-pound quarterback. One is much larger and can move things around more than the other. So the size of those orders, okay, remember that ticker tape or the time and sales window will show the time of the order and the size of the order. Okay, so a 50-lot trade is much larger than a 5-lot trade. And then, of course, it's order condition. Now, order condition means it refers to which side of the bid or the ask spread the trade was executed on. Okay, so if you're going long on any contract, you want to see a lot of orders being executed at the ask. Okay, on the opposite side, when we're going short, We want to see orders being filled at the bid. Okay, so the order condition is going to tell us, are the buyers being sopped up like a dry sponge, okay, by all the sellers? If they are, okay, then we know there's a lot of activity in the market, a lot of appetite causing price to move up or price to move down. Okay, so the order condition, in other words, how they're executed. And then, of course, we use it specifically for timing of our entries and our exits. Most importantly, is usually going to be used with our exits. Okay, by timing, I mean, if we're anticipating a trade setup to be happening, we're then going to tune into the time and sales window, start reading the tape to give us a heads up on what the most likely event's going to happen in the future. So if we're looking at specific patterns, which is what we use specific patterns that develop on the time and sales to tell us when we may want to get into a new trade, or where we use it more commonly is exiting a trade early, taking profits early, or cutting that trade at a small loss rather than taking a full stop. And once again, the last, mostly might be one of the most important aspects of it, is how we use it, is we use patterns to identify potential moves. Okay, those patterns will tell us when to get in, when to get out. In other words, they're going to give us that heads up we're looking for. So the purest form of the market, time and sales, and these are the ways we use it. Now, we have lots of different patterns that our members are well educated on, and these patterns we'll go over very quickly. For more information, come join us 30 days for a free trial, or become a lifetime member of the School of Trade, and we'll show you not only the names and the specifics behind these patterns, but when we use them, how they're used in your trading, and how you can really use this to increase your confidence, decrease your risk, and make you an overall better trader. Okay, now the first pattern is kind of what we would consider to be a healthy auctioning market. Okay, so price moves up, it's met by buyers, it then auctions back down, met by sellers. And it keeps repeating this back and forth. Okay, there are equal buyers and there are sellers. Okay, the buyers and sellers are participating actively in the market. Okay, so that's going to be what you would consider to be a healthy or liquid pattern of price action. Now for pattern number 2, same